All right, hello everybody. Welcome back into the Netpicks Options Academy. In this video, I'm going to walk you through a couple of trades that I've been looking at here today. That way you can see how we piece things together from start to finish. The beauty about trading options is that you have a ton of flexibility in how you take the trades. You can really control your risk to better reflect what your outlook is for that specific market, but also for the market as a whole. Today is a perfect example of this because, in my opinion, the market is extremely overbought in the near term. Doesn't mean this market can't head higher from here. It just means on any bullish trade that I get on my charts going forward, I'm going to be more conservative. There's a couple different routes that we can go to do that. I can cut back on my size. I can use a different strategy altogether, meaning I could go to a vertical spread instead of buying an outright call, or I could go farther out in time. The farther out in time that I go, the more conservative the trade is. Any combination of those three approaches are fair ways of controlling my risk and reducing my exposure if I wanted to be more conservative. So let's go ahead and put that into practice and show you what I'm talking about. We're going to take a look at two different examples today, one utilizing the Spotlight Power Trader system and the other utilizing our Options Fast Track system. The difference between the two: we're going to start out with the Options Fast Track, and we're going to take a look at TLT, which is the bond ETF. The Options Fast Track is a much faster system. We're utilizing range-based charts, which means we're focused exclusively on price action and not on time at all. So if I take a look at this chart of TLT, we are using a range-based chart of 48 cents, meaning every candle on this chart represents 48 cents of price action from high to low. It could take 5 minutes for a candle to form. It could take 2 days for a candle to form. The system reacts much faster to changes in trend, which can be important for us in a fast-moving market. We really haven't seen a lot of follow-through in this market in either direction. It's just kind of been a slow, methodical grind. But intraday, we've actually seen some decent movement. The range-based charts are going to allow us to react faster to those changes intraday. Doesn't make it a day trading approach. We're still very much looking for a swing trade. We're looking to hold for anywhere from 3 to 7 days, but it allows us to get more frequency, allows us to get in and out of trades faster. Now, looking at TLT, in many cases long term, we have seen an inverse correlation between bonds and equities. Meaning if equities are going to start to sell off, in many cases, you'll start to see bonds rally. Now, it's been a little bit more difficult to see that inverse correlation the last few years, with the central banks so active in these markets, with interest rates at very low levels. We haven't seen near the activity, near the two-way activity, that is, in bonds. Now, we are seeing a long setup on this chart on TLT, and the way I know that, if you take a look at the blue dots here on the right edge of my chart, you can see I had my entry dots right here. I had my two targets up above, and I had my stop down below. Now let me pull up my data box so we can take a look at the specifics of this trade. The whole basis for this trade is if I take a look at the %R indicator down at the bottom, that's the indicator that we have down at the bottom of the chart, we got a move below -90 towards the tail end of last week. That told us we were oversold in the near term. That's not enough on its own to just strictly give us a long trade that we can jump into right away. We have to wait for added steps of confirmation. And the first step there is I need a close. I need one candle to close above my signal line, which is that solid white line. That ended up happening for us back on Friday of last week. The third and final step is I need to see price action come up and touch that entry point. Price action doesn't need to close above that entry point. It just needs to touch it intraday. And that happened here first thing this morning. This trade set up for us end of last week. It did not trigger in until this morning. So we had a whole series of days to get this trade ready to go. It's not something where I have to sit there just glued to the screens all day long. I let the market do its thing. I come in a couple times a day to look for these types of setups. With our entry point being touched, let me go ahead and document this entry point, and let's talk about some different routes that we can go to take it. So the entry point is at 119.50. I'm also going to jot down our full second target up at the top of the chart. It's that second series of blue dots right up there at 121.32. Let's take that information and let's go over to the trade page and let's piece this thing together. We've been talking in our training room quite a bit about how in this type of a slow environment, we're in the month of August, it's a prime time for vacation season, oftentimes you will see low levels of volatility, and we're getting that. The VIX here today, Last time I checked, it was down in the low 11 handle. It is. It's at 11.35. That's a very low volatility reading. There's no volatility anywhere in this market because we continue to head higher day in and day out. There's a lot of complacency here, people just assuming that every dip is going to be bought, we're just going to head higher indefinitely. As a result, when the volatility gets that low, oftentimes you'll see slower markets. We typically see longer holding times. Things take longer to develop. We're also going to see very inexpensive option prices. At Netpicks, we're big believers in using a very diversified approach with our option strategies. There's times that we like to buy outright long calls and long puts. There's times that we like to buy vertical spreads, and there's other times that we like to use credit spreads. We don't fall into the camp of strictly selling options or strictly buying options. We're all about taking what the market's giving us. It's a little bit more difficult to sell premium here right now because the volatility being so low is leading to very inexpensive options. Very difficult to collect enough premium to really give us a good reward to risk ratio. So because of the low volatility and because we're in the summer months, we're expecting longer holding times, there's been some things that we've done in our own trading to better reflect the current market condition. Number one, we've been going out to the September monthly options. On the trade page here on TLT, you'll notice the number in parentheses there is 46. These options have 46 days left to expiration. It's a little bit farther out in time than we normally go with our options fast track system. By going out farther in time, we're going to pay more for those options up front, but it's actually a more conservative trade. The farther out in time that we go, the slower those options are to react to changes in stock price. It's known as the gamma. If this market was very volatile, if we were seeing a lot of short holding times, by going with the shorter term options, we would give ourselves more profit potential. The gamma would be working in our favor potentially. The problem there, the closer we get to expiration, the higher the time decay becomes. So it's actually a more aggressive trade. If you get into a shorter term option and the market doesn't move in your favor immediately, you're going to be in trouble faster. We want to try to avoid that. One of the routes to go there is to look at the monthly options farther out in time. That's what we've been doing in a lot of our recent trades. So I'm going to take a look at the September options. The system on the chart is giving us a long trade. So we've got a couple of different routes that we can go to take this trade. I could just buy an outright call option. It's the most aggressive route to go. It gives me the most profit potential. It also comes with the most risk. If I just buy an outright call, the only way I make money is if TLT moves to the upside, and it does so quickly. If I don't want to be that aggressive, if I want to be a little bit more conservative, instead of buying a long call, I could buy a call spread. I could use a vertical spread to reduce my cost. Yes, I am also reducing my profit potential, so it's a lower reward, lower type of risk position for us. I'm perfectly comfortable with that as long as it matches up with my risk tolerance and with my outlook for the market. I could also potentially take a look at selling a put spread. Selling a put spread is actually a bullish position. By selling a put spread, we actually put the time decay in our favor. So the longer we hold the trade, the more the time decay helps us. So if I've got 3 different routes that I can go to take the trade, which one do I go with? The neat part about this is they are all bullish positions. There is no right or wrong answer here. It depends on how much risk you feel comfortable taking. I've been very conservative with a lot of my trades lately because of the slow market action that we've been seeing. For me, by cutting back and getting more conservative, that's meant a couple different things. I've been going out farther in time with the September options. I've been using smaller position sizes, and in many cases, I've been using the vertical spreads. That's the route that I've been going, and it's worked out quite well for me, even though I've left some profit on the table in some situations. We just closed out of a full profit winner on Facebook here within the last couple of days. I got more conservative on that long trade. Still booked a profit. It was just much smaller than what I normally see on a profitable trade because I got more conservative. So it's not a perfect science. You're not going to be 100% right on every call that you make. If I get into this TLT trade and I take it with a call spread and it comes up and hits full target, well, the long call would have made me more money. Don't kick yourself. You want to make sure you're taking risks that meets your outlook given the current market conditions. None of us know what's coming from day to day. What I don't want you to do is just swing for the fences on every trade and just buy calls and puts and hope for the best, because that might not always match up with the current market conditions. Focus on long-term success. Focus on taking what the market's giving you, and you will be far better off for it long-term. So let's talk about the long call here first. With our entry point at 119.5, we're basically sitting right there. We're sitting at 119.55 at the time of this video. We like to get 1 to 2 strikes in the money from the entry point on the chart. We also like to take a look at the delta. The ideal scenario for us is to find a delta between 0.6 and 0.65. Well, notice the 118 call gets me slightly in the money, gets me a couple strikes in the money. I also have a delta of 0.65, so that one meets my criteria. And this one's currently trading for around $2.40 or so, right around $240 per contract. If I wanted to buy that call outright, I could certainly do so. Again, it's going to have more profit potential, but also comes with more risk. So we get a couple strikes in the money, we go out to the September options, and that's the route that we could go to play the upside. Let's take a look at the call spread as well. Just in case I wanted to be a little bit more conservative, what could I do to cut some of the costs on that trade? I could also take a look at buying the call spread. To buy a call spread, we like to buy the option that's 1 strike in the money from the entry point on our chart, and then we like to sell the option with the strike price as close to the second target as we can possibly get. So going 1 strike in the money, I'd be taking a look. Let's go ahead and take a look at we'll just stick with the 118 call. Instead of buying the 118 call outright, I'm going to right click on it. Let's go to buy and let's go to vertical. So I'm still going to buy that same 118 call, but now at the same time, I'm also going to take a look at selling an option with a strike price as close to the second target as I can get. My second target on the chart is at 121.32. So let's take a look at selling the 121 call at the same time. Let's take a look at what this does to the cost of the trade. If I buy the outright call, we're talking about $240 a contract. By going with the call spread, I'm able to lower that cost down to $1.55. I'm able to almost cut $100 off of the cost of the trade. Following our criteria for a vertical spread, in most cases, we're able to reduce our costs by 30 to 50%. It's still a bullish trade. We still use the same target, same stop. None of that changes. The only difference here is now I'm taking a trade with less risk. Okay, so now the question becomes, which one is the better route to go? Is there one that is the clear-cut winner? Do I go with the long call? Do I go with the long call spread? It does not matter to us. As long as you're comfortable with the risk, they're both bullish positions. We don't do anything different with how we manage the trade. Okay, so again, we're buying the 118 call. We're also selling the 121 call, both in the September monthly options. And we're paying right around $1.55 for that position. All right, now let's take a look at one final way that we could take this trade on TLT. Let's take a look at selling a put spread. Selling a put spread is also a bullish position. The difference here is now that we're using a credit spread, by collecting that premium up front, we're putting the time decay in our favor. So selling a credit spread, what we like to do is go to the junky out of the money options. So I'm going to go to the out of the money put options here on TLT. And let's go out to the 118 puts. So they're slightly out of the money. I'm going to right click on that 118 put. I'm going to go to sell and I'm going to go to vertical. Down at the bottom, I am selling the 118 put, and at the same time, I'm buying the 117 put. It is a fully risk-defined trade. It's trading for right around 29 cents. I'm going to round that up. I'm going to move it up to 30 cents. Let's say we collect 30 cents to put that trade on. Let me show you the order confirmation box. This is still a bullish position. I still want TLT to move to the upside, but it's a much more conservative route to go. If I collect 30 cents, the 30 cents that I'm collecting are $30 per spread. That's the most money I can make on the trade, regardless of what happens to TLT. If it goes to the moon, let's say it moves to the upside by $5 over the next couple of weeks, the most I can make is $30 a spread. The key here is look what type of capital it's tying up to put this trade on. It's only tying up $70 of capital. All right, in the earlier two trades, the long call and the long call spread, we're talking about between $150 and $250 for just a one lot position or a one spread position. Well, we're able to lower that cost even further by using the credit spread. We're able to lower it down to $70 per spread. Very manageable regardless of account size. You could certainly take this with multiple spreads if you wanted to. You could put it on 10 times and only have $700 at risk. It's still a bullish position again, so I still want TLT to move to the upside, but now we're drastically reducing our risk on the trade. We're also giving ourselves multiple ways of making money. Look at my break-even point on this trade. It's at 117.70. That's calculated by taking the 118 put that I'm selling. We're going to subtract the 30 cents that I'm collecting to put the trade on, and that puts my break-even point at 117.70. I just need price action to stay above that level. If it does, I can make money. So if it moves up, down, or sideways, I can make money in all three market scenarios. TLT is currently trading for right around 119.60. It could move $2 against me, and I can still make money. I can be dead wrong on the direction of TLT, and I can still make money. The only move that really hurts me is if TLT makes a big move to the downside and it moves down past my break-even point. I also make money from time decay adding up. So every day that passes, I get to make more money on that position. And I also make money if volatility decreases. So I give myself 5 ways of making money on the trade. Really great position. And what's cool about trading options, because we're tying up such little amounts of capital here, you could split your position. What if you come in and say, all right, let's go ahead and buy a call option. We'll spend $240, $250 to buy the contract. And then at the same time, let me go ahead and sell a couple of put spreads. What that does for me is the long call gives me a home run profit potential as long as TLT moves to the upside quickly. But what if it doesn't? What if we kind of drift sideways to slightly higher? Well, the short put spread allows me to make money from the time decay. By splitting the position, I give myself more ways of making money on the trade. And I do that quite often, especially in a market where we have decent volatility. So the system tells us whether we need to be bullish or bearish. We got that by the dots on the chart. Okay, let me go ahead and get rid of that order confirmation box. So we took the setup on the chart. All of that hard lifting's done for us. We know we need to be in a bullish position. All we have to do on our side is decide, okay, do I want to go ahead and buy a call spread, or sell a put spread? And there's no right or wrong answer. They are all bullish positions. It just depends on how much risk we feel comfortable taking. And I love that flexibility. You can't find that flexibility with any other market out there. Right? So that is the TLT position. So now that we're in the long trade, 120.36 and 121.32 are the targets up above. If we hit that first target, I'll close out of half of my position there, book the partial profit, and then also move my stop up to break even. I'll move my stop up to the entry point and take the risk off the trade. So now everything is outlined for me from start to finish on the TLT trade. Let's jump over and take a look at the Spotlight Power Trader system, because we got a long setup on QQQ today, which is the NASDAQ ETF. So let me go ahead and load up that chart here. And let's take a quick peek. This one was a tricky one. It's tricky because the system's giving us a long trade. I don't want to be very aggressive on the upside. I think the market's incredibly overbought here. The NASDAQ has made a pretty impressive run thanks to names like Apple and Facebook and Amazon. The question becomes, how much does it have left in the tank on the upside? In my opinion, we're going to start to see some slowdown here in the very near future. I don't think the market's going to completely tank out, but a period of consolidation or a healthy pullback might be in store in the very near future. However, this system gave me a long setup, and you can see the blue dots there that started printing last week. This blue dot, the entry point at 180.74, that level was hit here today, so I have to respect the system and I have to take that trade. It does not mean I have to jump in and just buy an outright call. Remember what we just talked about on TLT. We have flexibility here. I can adjust my risk based on what my outlook is for the overall market, but specifically with QQQ. I can adjust my position size. I can adjust the option strategy that I use, and I can adjust how far out in time do I go with the expiration cycle of the options. What I did here on this trade on the upside on QQQ, I cut back on my size drastically. I'm in this trade with around 10% of my normal position size. Reason being, I know I have to be bullish here. The system's telling me I need to be, but my outlook for the market is very conservative. I'm going to give myself a chance to make money on the upside just in case this market does continue to move higher. But what if the market does turn immediately? I'm drastically reducing my risk. And that's what I'm looking for because of my outlook for the market. How do I know to be more conservative? Because I look at the market every day. I look at the same watch list of products every single day. I've traded QQQ now for years. Doesn't mean I'm going to be perfectly correct on all of my positions, but I get a feel for how it trades. And tracking it here lately, it's been impressive on the upside. And I think it's very overdue for a slowdown. And that's why I want to be more cautious on the upside. So let's go ahead and jot down that entry point. Again, the entry point is at 180.74. The full target's all the way up at 198.02. So you look at that full target and, we need another $18 move to the upside to hit full target. That's a long way to go, right? The way the Spotlight Power Trader is structured, number one, we're using a time-based chart. This is a 195-minute chart. It's very much a slower moving system when compared to the options fast track, which we took a look at over on TLT. You're going to have longer holding times. You're going to go for bigger setups, but the way that we have the money management rules built in is we're looking to reduce our risk and we're looking to lock in a little bit of profit as quickly as we possibly can. That'll happen if we hit the first target at 186.15. In many cases, because we're able to initiate a trailing stop very quickly, within a couple of days, in many cases, we're able to reduce that risk and lock in a little bit of profit. That way, if we don't go all the way up to 198 and hit the full target, we're going to be able to lock in a little bit of profit as we go along the way. So let's go ahead and take those numbers that the setup is giving us on the chart. Let's go over to the trade page and let's walk through a couple of different options here. Just like TLT, I'm going to stick with the September monthly options with 46 days left. I want to have more time here because the market is so slow. I don't want to get caught with the shorter term weekly options and have that time decay kill me. A lot of people love the weekly options because they're cheap. It's certainly true. You just have to be cautious. You have to be picky on when you use those weeklies. In a period like we're in now where the volume is extremely low market-wide, the volatility is non-existent, be cautious with those weeklies. You can get hurt very quickly. They're cheap for a reason. They have a very low probability of success if you're going to buy a weekly option. Because of all that, I'm going to go out to September. With our entry point at 180.74, let's take a look at some in-the-money calls. The 181 calls are going to be the at-the-money calls because that's the closest strike price that we can get to the entry price on our chart. I want to get slightly in the money from there. I'd like to go 1 to 2 strikes in the money or find the delta between 0.6 and 0.65. Take a look at that 179 call. It gets me slightly in the money from the entry point on our chart. It also gives me a delta right around 0.60. So right inside of the sweet spot that I like to look for. I don't have to worry about liquidity here. There's plenty of volume and open interest on QQQ. It's one of the most liquid products on a daily basis. So I know I don't have to worry about that like you would on some of the other names out there. If I just buy the 179 call, we're talking about over $500 a contract. Okay, it's trading for right around $5.10. It's expensive. It's expensive because we're going almost 50 days out to expiration. That can be intimidating for some people because you take a look at that and say, I can't have $500 in one trade. You've got to remember a couple things. Even though we're paying more for that option up front, it's actually a more conservative trade because going out almost 50 days, going out 46 days to expiration, those options are going to react much slower to changes in stock price. If that trade triggers in, it's going to take more capital up front, but let's just say it loses. Let's say it hits stop. We're actually going to be left with a lower percentage loss because we're going out farther in time. That's a big missing piece for a lot of people, and they don't understand about the pricing model of an option. The farther out in time that you go, it's actually a more conservative trade, even though you're going to pay more for it up front. So the long call, it's the most aggressive route to go. It's going to give you the most profit potential, but it also comes with the most risk. Let's go ahead and let's try to be more conservative. Let's take a look at a call spread. Right, so let's take a look at, we want to buy one strike in the money. So let's take a look at buying. Let's go ahead and take a look at buying the 179 call. So I'm going to right click on it. Let's go to buy and go to vertical. Our criteria states we want to buy the option that's one strike in the money from the entry point on our chart, and then we also want to sell the strike closest to the second target. Here's the problem that we run into with such a large setup on the Spotlight chart. If I sell the option with a strike price as close to the second target as I possibly can get, that would have me selling the 198 call. Okay, I have to go all the way out to the 198. It doesn't allow me to collect much premium there. I'm lowering the cost of the trade by 5 cents or $5 per spread. That doesn't make much sense. So what I would do in this case, because it's such a large setup, instead of selling the option where the strike price is close to the second target as I can get, I'm going to start to move that short strike closer to the current stock price. Instead of selling the 198 call, let's take a look at selling the 185 call. See what that does to the cost of the trade. Now I'm able to lower the cost down from $510 all the way down to $338. So now it becomes a little bit more realistic. We're starting to approach that 30 to 50% cost savings that we like to look for with a vertical spread. It's still a bullish position. I still want QQQ to move to the upside. I still have a tremendous amount of profit potential. I'm just able to reduce my risk somewhat by using the call spread. Again, there's no right or wrong answer here. It just depends on how much risk you want to take at this point. I want to be more conservative on the upside, so I actually lean towards looking at the long call spread. That one matches my outlook more, and it's not solely based off of a price. Right? I mean, most people can afford to put $500 into one trade. I'm not necessarily strictly looking for cost savings here. I'm taking a look at the call spread because it matches up with my outlook for the market better. I want to be more cautious on the upside given the overall overbought nature of this market. So that's the $6 wide call spread. I'm buying the 179 call. I'm selling the 185 call at the same time, and we're paying $336 per spread to put that trade on. The problem with both of those positions, the long call or the long call spread, is we only have one way of making money on those trades. The QQQ has to move to the upside quickly. It's the only way I make money. If it starts to chop sideways, if the trade takes longer than expected, the time decay is going to hurt the position. So one of the ways to minimize that, the third way that I could take this long trade, is to sell a put spread, just like we did over on TLT. It's the most conservative way to go. It gives us the least amount of profit potential, but it also gives us the highest probability of success. What I want to do is go to the out of the money put options. So let's go ahead and let's take a look at the 177 puts. I'm going to right click on the 177 puts, go to sell, and go to vertical. So I'm selling the 177 put, and at the same time I'm buying the 176 put. There's a dollar wide difference between those strikes. What we teach our students is we want to collect between 30 and 40% of the width of the strikes. With there being a dollar wide difference here, I want to collect between 30 and 40 cents. Instead of selling the 177 put, let's go ahead and adjust these strikes a little bit, because the current 177, 176 put spread only allows me to collect 24 cents. It doesn't meet my minimum criteria. I need to collect between 30 and 40 cents. In order to collect more premium, I've got to move my strikes closer to the current stock price. So instead of selling the 177 put, let's sell the 178. And then we'll also buy the 177 put at the same time. It's still a dollar wide spread. I'm just trying to collect more premium. Well, now I can still only collect 26 cents. So let me adjust those strikes one more time. Let me adjust it up to the 179, 178. It's still a dollar wide spread, but now I can start to collect closer to the 30-cent number. The problem that we're running into this market right now is the volatility is so low, the options are very inexpensive. There's not a lot of premium there to collect. This allows me to collect 30 cents, so it does meet my minimum threshold of 30%. I'd be collecting 30 cents or $30 per spread. That's the most I can make on the trade. I'd be risking $70 per spread. So I'm right around risk 2 to make 1, and I'm very comfortable on these short spreads to be in a position where I'm risking 2 or 3 to make 1. The reason I'm willing to accept that is I have so many ways of making money on the trade. I've got 5 ways of making money on this trade. My break-even point's at 178.70. It's calculated by taking my short strike, my 179 put that I'm selling. I'm subtracting the 30 cents that I'm collecting to put the trade on, and that gives me my break-even point at 178.70. Price action just has to stay above that number, 178.70. So it's about $2 below the current price action. I can be dead wrong on QQQ. It could start to move to the downside. If it moves $2 against me, I'm still okay. So as long as price action stays above my break-even point, up, down, or sideways, I can make money. I also make money from time decay adding up and from volatility decreasing. So I give myself 5 ways of making money on that trade. The only move that hurts me is if QQQ makes a large move to the downside. Okay, so if that happens, yes, I am going to lose on the trade. The cool part about this is whatever happens, if I am dead wrong, the most I can lose on this trade is $70. So I'm able to reduce that cost in a pretty big way. So if I buy the long, if I just buy the long call on QQQ, I'm talking about $500 per contract. If I buy the call spread, I'm talking about $330 per spread. If I sell the put spread, I'm talking about $70 a spread. So now you can see the range of aggressiveness here. Long call, most aggressive route. Slightly more conservative, the long call spread. And most conservative is the short put spread. They are all 3 bullish positions. It just depends on how much risk we feel comfortable taking. A lot of times people get confused on that and they get intimidated by that when they first start to learn options. There's so many choices there. How do I know which route to go? I look at it as a benefit. We have tremendous flexibility here, more so than any other market out there. I don't have to be limited to just buying an outright call or a put. I can use vertical spreads in a couple of different ways here to reduce my risk and also improve my probability of success. When you start to take advantage of what the options offer long term, a lot of times people will shy away from the advanced strategies because they think they're more risky. They're actually not. Those vertical spreads are ways that we can reduce our risk and improve our performance long term. In my opinion, using a combination of both is the best route to go, because going forward there's certainly going to be times this year yet that I'm going to want to be more aggressive. When the market starts to pick up, I'll buy more calls and puts. If the market stays slow here in the summer months, I'm going to use more vertical spread. So having that flexibility there will give me a better overall equity curve long term, and that's what we're all looking for as traders. So I know a long-winded video here, but I wanted to walk through this in detail. That way you can see my approach, how I build in layers of diversification, how I take trades that meet my outlook for the overall market and for the individual product that I'm trading, and then also showing how we can utilize the flexibility that options offer. So if you'd like more details on these trades, feel free to send me an email, mike@netpicks.com. If you are a current student, if you're a current Options Academy student, feel free to log into the training room here this week. We're going to be in there Tuesday, Wednesday, Thursday at 12 o'clock Eastern, and then also Thursday evening at 8 p.m. Eastern. We're just going to follow the same outline here. We're going to walk through live trades, walking through how we can take what the market's giving us and just provide a perfect opportunity to ask questions in real time. So I'm going to wrap this video up here. Again, if you have any questions, feel free to contact me directly. Mike@netpicks.com is the email. So I'll be back here later in the week with our next video. We'll talk to you guys then.